Well, as promised, let's get chatting with the management of Cigniti Tech. In its second quarter, they saw revenue surge by nearly around 40% over the corresponding quarter, while the EBITDA margins as well did expand by close to 400 basis points. Well, that was fairly impressive. But to understand more about the past quarter, the way ahead as well, we're joined by Mr. Krishnan Venkatachari, the CFO of the company. Hi, Mr. Venkatachari. Thanks so much for joining in. Well, I recall when we last chatted earlier this year, you were saying that you're looking to get to mid-teens in terms of margins. Now, you've got there. Do you believe that this 15% margin odd band is sustainable? And also give us a sense on attrition. The entire sector was struggling with it. I think attrition for your company is close to 28%. Do you believe it's peaked out? Will it trend lower from here?
First on the margin side, I think we are very confident and will be sustaining these levels. And we are trying to make efforts to see that how best we can move by a couple of basis points. But I think over the quarters and not immediate quarters. When it comes to the question of attrition, I think we are currently hovering around 27% or so. We feel that it has peaked out and we have done enough of retention methodology. And we feel that it's going to go down and there are a lot of steps which are being taken. So that is going to be definitely an additional positive point for us.
Those are a couple of positive points that you've mentioned, that the margins will sustain at these levels and attrition has peaked out. Mr. Venkatachari, just wanted to understand, your outlook on the revenues itself. The first half of this year, you've done almost 39%. You've always been targeting mid to high teens sort of revenue growth. Wanted to understand what the plan for this year is. And I ask this specifically because UK and Europe accounted for a little over double digits of your overall sales. You set up an office in Prague last year to expand into that market, but currently we are seeing some sort of growth headwinds in that geography. So in light of that, what kind of revenue growth can you guide for this year, and what's the prognosis on that geography itself?
That's a good question. Actually, we have been predominantly weighed heavily on the US markets. If you look at the quarter, probably, or the first half of the year or the quarter, if you look at it, we have been at about 92% coming from the US market and the rest 8% from the rest of the world. While it is so, basically, I think UK traditionally has been contributing close to about 7-8%, which over the last couple of quarters have taken a little bit of headwind. But we are confident that the kind of efforts which we have put in and then the kind of focus what we are trying to get through, the traction seems to be quite high. While it is so that the challenges lies ahead in terms of the UK and Europe market, the purpose of opening up a nearshore center at ZEC, which is very clearly to attract and tell the customers clearly that we are available on a nearshore on the European market, to work on their time zones very clearly. So we see a lot of tractions coming ahead, and I think in a couple of quarters probably ahead, you will see a lot of good news flowing through. Though it is not forward-looking, but I think the kind of efforts are going to culminate that way.
So what
when it comes to the question of managing the revenue, I think the growth part is intact very clearly. I think the first 6 months we have achieved about close to $101 million in terms of revenue. And we don't give any guidance, but invariably looking at the order book, looking at the run rate where we are today, I think we should be comfortable doing high teen growth, which should take us to cross the borders of 200 million for the current year.
You have already done 101 million, right, sir?
Yeah, absolutely.
So
absolutely.
200 should be par for the course, right? If you're going to be at...
So considering all the scenarios, I think the current run rate looks very interesting, and we should be up and about 200 billion.
Okay, more than 200 billion. Okay, all right. The other point is you have given a long-term vision that by 2026 you want to be, I think, a $500 million company, and 2028 you want to be $1 billion company. That's going to be quite a tall ask, it seems. Particularly the $1 billion mark. How much of that will come in from inorganic growth? Do you have some plans out there? And also give us an update on the cash in your books, because you've been looking at inorganic growth. Go ahead.
Yeah, absolutely. If you look at, probably it's always we and the management strongly believe in setting up a target very clearly, which is a tall target, and start working towards it, which is what is always interesting and keep pushing us beyond. And if you look through about $1 billion journey, or even a 500 million, if you look through the end state at $1 billion, probably we expect about 65% of that to come through organically over the next 6 years, and the rest will come through inorganic mode. There are various methods in terms of inorganic mode. If you look at the first 6 months, we have generated about close to 60 plus crores in terms of cash. The cash as it stands in cash and cash equivalents today is about close to 195 crores. So the next 2 quarters again will keep generating cash. So cash is not a debt, but I think there are other methodologies in terms where we can try to push through and do inorganic. But I think the inorganic, we are trying to be very choosy and picky in terms of trying to look at the value addition and the volume addition systematically. So as I speak to you, there are a lot of proposals which are reviewing. But I think as and when it crystallizes, we'll be able to get it. We are pretty confident we'll be able to get there. Please go ahead.
Yeah, just wanted to probe you a little on that inorganic part as well. I mean, if you're a billion-dollar company, you would be looking at $350 million coming in from inorganic, and you yourself haven't crossed the $200 million mark yet. You are, hoping to cross it this year itself. What are the kind of proposals that you're looking at when it comes to inorganic? Because for you to be able to buy a company that scales up to $350 million, the talk should start from now itself, I presume. And secondly, how cast in stone are these $500 million and $1 billion targets? Because you've moved the goalpost once as well on this $500 million target itself.
Yeah, so to just step back a bit, probably the top accounts contribute about 20 accounts contribute about 50% of the revenue currently. With the recent acquisition of the Apara Digital, which is Roundsquare, I think the doors which are opening up for the opportunities on the product development side in terms of offering digital transformation services, we see a traction which is quite high. So that is one of the confidence. The second thing is that these acquisitions, what we are talking about, is going to be tuck-in acquisition in the order of the size of about close to 40-50 million, which are in the niche areas and which has the potential to grow. And it need not be a single acquisition going to about 350 million. As we start doing one or two acquisitions out very clearly in a span, the aggregator will start and putting up to close to about 350 million. And that is how we're trying to position and put the target out very clearly. While on the organic front, I think we're extremely confident on the 20-25% plus growth over the next couple of years in terms of pushing it through with the kind of offerings what we have on the table.
Mr. Venkatachari, what about closing out one of these inorganic growth, targets that you're looking at? Should we hear from you in FY23 itself? You believe you can close it? Point number one. And point number two is, the last time we chatted, when we spoke earlier this year, you were saying at current valuations, the promoter entity believes that the shares are attractive. At current reckoning, what is their view? The promoter holding has moved from around 34% to around 37%. Go ahead and answer both these two questions.
Absolutely. To that, as regards inorganic, I reserve my comment basically because we need to publish it uniformly through the exchanges. But we are positive and quite optimistic. I will leave it at that note very clearly because there is an aggressive set of evaluation which is happening around. And also keeping at the back of the mind that we have a target and we have a vision where we need to achieve. So I would like to put it out that way. When it comes to the valuation, I think we demonstrated very clearly. Still, the promoters feel that the current valuations are very attractive. Clearly, given that the kind of the numbers which are stacked up over the last 2 quarters cumulatively and where we are heading at in the current year, which anybody can do the math. I think that is one of the signified intent. We did a buyback very clearly, which shows very clearly that the company is confident of itself in the business. And still the promoters feel that the valuations are attractive and at every opportunity and point of time. So they will definitely depend to increase their stake.
Mr. Venkatachari, is there a target holding that you want to take it to from around 34%, 37%? If they're believing that it's attractive, the stock has already risen from May onwards when you said that you were a buyer. To current valuation. So any particular holding, the target that you want to take it 40, 45% or something on those lines in the next couple of years?
I will not pin the percentage down, but I think very clearly that their intent is to move the inch forward and then continue to be enhancing their value, enhancing the holdings.
All right, we hear you. Let's talk about a couple of your segments then. Travel and, tourism accounted for a fair chunk of your revenues pre-COVID. That dipped during COVID and, the data point suggests that it's back and how beyond pre-COVID levels as well. How much does that contribute to your revenue now? How is that likely to grow? And the other two verticals, retail and e-commerce, those were also likely to be your growth drivers. How much do they contribute? What are they likely to grow at?
Absolutely. I think during the COVID time, while 28% travel contributed, I think we learned from the mistake and we have de-risked the portfolio, and BFSI and retail have really gained traction, contributing about 22 and 17%. While we have retained the relationship on the travel has contributed at about 14%. So if you look at the growth drivers continue to be retail and BFSI. However, travel traction has now bounced back. So we are very optimistic that this growth is going to be definitely coming back to the pre-COVID levels very shortly. And we have done enough research in terms of providing the right kind of offerings and setting up the technology centers very clearly. So these three sectors will definitely contribute.
And what about your onshore-offshore mix right now? Where does it stand at? And what exactly is your onshore utilization? Offshore utilization.
My offshore utilization stands at 76.8, which is roughly about 77%. My on-site utilization is at about 96%. My resource mix is at about 22 on-site and 78 offshore. My revenue mix is at close to 51% on offshore and 49 on on-site. I'm trying to push the ant with all this visa and other region to 55% so that my margin traction can start improving, and try to cover that up with the volume very clearly, which more and more clients are intending to really push to the offshore. So that is a positive news.
All right. Thanks a lot, sir, for joining in. Always a pleasure speaking with you. Wish you good luck. And also season's greetings to your team members and your family as well. With that, we step into a short break. On the other side.